Got me walking through life, still trying to figure out where I fit, that's my fall through the night. But I never knew myself like this, the therapy fee when I spoke to the mic, yo.
So, most retail traders, they think that looking at a chart and figuring out what the pattern is, what the indicator says as far as the RSI, stochastics, whatever they choose to do, is the answer to timing a trade or getting a bias in the market. And unfortunately, as we've seen in the recent weeks for the first quarter of 2025, that's not going to be the case moving forward, especially during a Trump administration where volatility in the S&P, the dollar, oil, bonds, every single asset class is going to be through the roof. So for this, I wanted to make an impromptu video about the importance of global macro. So global macro combined with order flow analysis, volume analysis, whatever you want to look behind what's happening in the chart, candlesticks, bars, whatever you like looking at when you come into the market. Those two are the tools that you should use because AI just killed technical analysis. There are now apps that can break down technical patterns, that can break down the indicators, and pretty much have wiped out the importance of a technician, so to speak, in the market. So today we're going to cover the first part, which is global macro. I think that order flow is going to get a lot more complicated. I think we should do something more on a live basis, covering order flow, covering the tape, so they can understand the depth of market, ladders, and everything that goes on behind the order flow process. So I want to guide you through a newsletter that we just wrote recently. It's titled Wake Up Neo. And I thought about this because I need people to wake up to the fact that global macro is one of the few tools that still works in the market today, especially as AI, like I said, killed technical analysis and anything that's short-term based. So sitting here in a beautiful cafe in Croatia, in the town of Trogir. It's pretty calm, pretty nice weather today, so I figured, why not? I'm enjoying a nice espresso martini, and with that, we're gonna get started in global macro. So, if you can see the screen recording now, we called for a turnaround in the S&P. This would have been the week of March 13th, and we started buying futures during the night, and then we tweeted about it in our main account. And the next day, sure as we tweeted it, the market ended up rallying by 100+ points. So we looked at not a single chart. We didn't look at any levels. We didn't look at any indicators or what some may call support in the market in order to get that turnaround. What we did look at was a foundational basis of global macro. So global macro, essentially, you have to start each day with a market bias, and there are only two biases. It's either bullish, bearish, but you can implement it in a way that says risk on or risk off, because there are assets that do well during a risk on basis and do well during a risk off basis. So when you start each day figuring out what the market is going to do today, whether the bias is risk on or risk off, it puts the odds ever in your favor to succeed during the day. And if you look at the order flow on top of that, then you already know who is stepping in, when, and what prices, so that you can exercise this bias in a much better way. So moving on to that, if you can see the newsletter now, you'd see that I plugged in this documentary about AI. So these are the quantitative traders that now rule most of the hedge funds. In fact, over 50% of the volume that goes on in most exchanges are driven by algorithms and short-term quantitative traders that squeeze out arbitrary statistical inefficiencies in the market, and this is within like seconds to minutes. Most trades don't last over an hour long. So if you're competing in that short-term time frame, even intraday trading, you are competing against guys like these that make thousands and thousands of trades every single minute, driven by quantum mechanics, quantum physics, like a crazy amount of modeling that goes into it. So you can't really compete with these guys. So what's happening now, and if you've been subscribed to our newsletter for a while, you understand that most investment banks and most hedge funds are now shifting those short-term trading roles to long-short equity portfolios, managing a global macro portfolio that lasts for 1 to 3 months so they can keep making the quarterly marks. So if you're not aware of how these strategies work, you are getting left behind, and you're still competing with the guys that are using machines and algorithms to trade the market short term. So with that being said, I highly suggest you watch that documentary I plugged in. It'll tell you a bit of the way that those algorithms and quantitative hedge funds are working right now. And keep in mind, that's from like 2017, 2018. So it's all gotten a lot bigger, a lot more complex by now. So, yeah, with that being said, I want to retouch the fact that AI just killed technical analysis. So if you're still competing in that realm, you're competing against machines and algorithms that literally are wiping out all the edge or alpha that is available in a short-term trading basis. So if you are in an investment bank and you're still in the sales and trading role, this is basically what happens any given day. You sit and watch algorithms work all day, executing orders and clicking around every once in a while when the model misbehaves, or you get on client calls, you get on the phone to answer questions and occasionally pitch something to execute a trade or an idea that the algorithms can't do themselves. So the real traders are going to what I already mentioned. It's either if you have a degree in quantum physics or you have a world class programming language experience, you're going to end up in the quant department for the investment banks or the hedge funds. So if you can prove yourself that you have a 1 to 3 month time frame using a global macro strategy, then you end up managing long short portfolios for 1 to 3 month time frames, and you actually get to keep some of the prop firm or proprietary departments of the banks, which isn't really that big anymore after the Volcker rule in 2008. But if you do want to trade the bank's money, it's either going to have to be in the quantitative departments, developing AI models and developing algorithms, or you have to go into a 1 to 3 month time frame using a global macro or long short equity strategy. So, on that note, here's a primer of the strategy behind global macro, long short equity trading, and how it kind of works on a given day. So, the start of each day, the first thing that you should have in mind is the narrative of the global markets. That means, are we headed to inflation themes? Are we headed to recession, a boom, bust, stagflation? Whatever the narrative is going to drive your views for the market. So, from there, you have established your macro bias, and then all you need to know is that the market can be a lot more complex than that on a daily basis. So while you can have a broader macro view of what the economy is doing, we all know that the market doesn't reflect the economy on a daily basis. It's a lot more complex than that. So I want you to ask two simple questions at the start of each day. The first one is, are we on risk on mode in the market, or are we on risk off mode? That's it. So let me explain what I mean by these two. Risk on means, are traders looking to take on more risk today? And to answer that question, you have to understand what the risky assets are in the economy and what the safer ones are. How they're going to do on each day and each week is going to tell you what the traders are looking to build up on their inventory, whether they're at hedge funds, banks, or individual wealthy traders. So here's a list of the risk assets that we look at each morning. Equities, of course, we have the S&P, the Nasdaq, the CSI 300 in China, the Nikkei 225 in Japan, the FTSE 100, basically world equities. If these are up, it means that the business landscape or the business outlook for those countries is up. So, of course, it incentivizes traders to take on more risk in their portfolios and their inventory. Then we look at currencies such as the dollar, the Aussie, the Canadian dollar. These are all commodity and leading currencies. So whenever the business outlook is bullish in any given economy, these currencies are going to do well because it's a risk on narrative of oil demand, of copper demand, of gold demand, basically inflation that comes through business activity. So after that, we are going to look at some of these commodities such as oil and copper, both of which are severely tied to the business cycle and the business outlook, the business activity in any given sector, any given country. So when oil does well and copper does well, along with these currencies, you can pretty much establish a risk on view for the day, for the week, for the month, whatever time frame you're looking at in this case. After that, of course, we have Bitcoin. So cryptocurrency is right now the riskiest thing in the market. And whenever the leader, the benchmark in cryptocurrency, which is Bitcoin, whenever that's good, it means there's a risk on narrative for the entire market. Whenever it's down, you can assume the opposite. So moving on from there, we have equity risk premiums. So this is the 10-year bond yield or bond price compared to corporate bond yields or bond prices, whichever one you want to look at. I look at prices. This is what I tweet out on a daily basis, weekly basis, to try to get our audience to understand how risk on and risk off kind of works any given day. So apart from that, we can also look at the spreads between the IVE and IVW ETFs. These are the value stocks and growth stocks ETFs. So whenever value stocks outperform growth, it means that people and markets and traders are in sort of a risk off mode. Because why would you look into safe, non exciting, low beta value stocks instead of growth if your outlook is going to be bullish? It doesn't really make sense, right? So whenever these spreads move in tandem of everything else that we just covered in this list, then you can get a clear picture of whether the market is on risk on or risk off mode. So if that all makes sense, you're gonna see these going up together, going down together most of the time, and chances are you're gonna have a pretty bullish day whenever these are up together, and a pretty bearish day whenever they're down together. They're not always gonna be so correlated and so connected, but it's your job to see what is going on throughout the day in all this list of risk on assets. So I'm going to plug in a tweet that we made on March 11th. So the opening was pretty bullish for the S&P. We pretty much broke down all these risk on asset lists that I just mentioned. So I mentioned that the opening seems a bit optimistic than previous ones in this week. Specifically, equity risk premiums are tightening, so the spread between them is getting smaller, meaning that there's a lot more appetite for risk in the market. So that's good for the Nasdaq, the S&P, the FTSE, the Nikkei, all the global equity markets that we just mentioned. So other than that, we have TLT, which is the bond ETF, pulling back. So right now in the first quarter of 2025, that TLT ETF has a $90 level. That is a significant pivot point of risk on and risk off. So on that day, the TLT pulled back to 90 and even broke down below 90. So in my opinion, that was going to be a risk on day because there's not a lot of demand for bonds, not a lot of demand for equity risk premiums. So the setup so far looks bullish for the S&P. Then we move on into the dollar. We didn't see it rallying. We didn't see it crashing either. It was kind of a flattish day for the dollar. So we can't really take it as a confirmation, but we can't either take it as a denial. So if the dollar started rallying, which it did later on that day, then if you go back to our list, it means that the outlook for the U.S. economy was getting on risk on. Oil demand was coming back in. Inflation outlooks were looking better as far as the business side, even though later we have cooler CPI, cooler PPI. But on that day, the view was risk on for the U.S. economy. So we move on to the growth versus value spreads. These pulled back. I think that day they pulled back by 10 points. It went from like 47 to 37 on the spread that we specifically look at. So essentially, value stocks went down by a lot while growth stocks started to outperform. And if you remember the little breakdown that I just gave you, that essentially means risk on. We're looking at no need to a flight to safety in value stocks, but rather a flight to growth, a flight to speculation in certain stocks. So after that, we have oil. So oil rallied about 1.5% that day. And what that means is essentially everything I just broke down for you. The outlook on business, the outlook on inflation, the outlook on demand and manufacturing activity, now that the dollar is shifting, now that the PMIs are shifting in the U.S. economy, drove oil demand higher. Therefore, you have a 1.5% day, essentially risk on. So ultimately, I did mention that I wanted to see the euro dollar pull back a bit, since the euro dollar exchange is one of the most liquid pairs in the forex market. So whenever people need a risk off scenario, they go to the euro dollar because of the liquidity. They know they can get in and out. They know they can serve their purposes short term. Essentially, I wanted to see the euro dollar pull back a bit to show me that risk on and not a lot of demand for a safe pair like the euro. As well, I wanted to see the Canadian dollar break in the week's high. Why? If you remember from the list, it essentially means that a breakout in Canadian dollar would be paired up with the oil breakout, which would be paired up with the S&P 500 bullish mode. It would be paired up with the risk on mode, from all the other currencies, from commodities and equity risk premiums, as well as the value versus growth spreads that did pull back. So I did put everything in the picture in the newsletter right here. This is something that I usually do on our Twitter account every single day, so that we give you a breakdown of what's going on in these risk on or risk off lists. So after we went through the list, we decided that it was time to go along the S&P 500. Of course, this is only half the equation. Like I mentioned in the beginning of the video, we do have to look at order flow. We do have to look at statistical analysis when it comes to volatility pockets, the ATR, and everything else that we cover inside of our community. So this is what I mentioned. Timing is a different topic, but on that day, we should have been doing nothing but buying. And if you see, the S&P was at 55.90, and we started buying live on Twitter, which we told everybody at 55.40, 55.50. Around 2 days later, we had a 100-point rally in the S&P, because every single day after this tweet started looking the same way, risk on. So here we go. We had the same 100-point rally, 100-point move in the S&P, and basically everything that we started looking at as far as the spreads, as far as the risk on list and checklist that we go through every morning, look favorable for a buy. So we should have been doing nothing but buying. So now that we covered risk on, we do have to cover risk off, so that you understand a bit of what the mirror image of this setup looks like. So essentially, you're looking for those risk on assets to underperform in the same way that we just broke down. So world equities, currencies, commodities, equity risk premiums, and the value versus growth spreads, they have to move in the opposite way to show your risk on mirror image, which would be risk off. So basically, when we have an increase in volatility, or our appetite for risk goes under for the day, you would see safer assets see an inflow of capital essentially outperform for the day. So that would be the euro dollar, like I mentioned, is the most liquid pair in the forex market. So a lot of people that need that solution for the day, they would flow into the euro. Then you have bonds. So as I mentioned, the TLT on that risk on day started to pull back. So you would see the opposite in a risk off day. Bonds would start to outperform. You could track it to through the TLT or any other ETF that goes over bonds here. So gold is also a pretty historically important risk off asset when there's volatility with uncertainty in the economy, whether it's the US, China, European economies. A lot of people flow into gold because of this. So for time's sake, I'm just going to leave you with that risk on scenario. I'm not going to break down the risk off. It's essentially the mirror image, and that's all you need to know. So on that note, I do want to give you one of the most important things in global macro, which is expressing your view through a trade idea. And for that, I want to bring you to the short dollar long bonds trade that we put on starting in November. Everybody burned us on Twitter. Everybody was saying that bonds were going to keep crashing and the dollar would go to 130. And well, we didn't get there, essentially. This is the before and after of that trade. As you can see, the dollar ended up going down by over 10 points, while bonds rallied by nearly 10% during that period. And we're still on this trade as of March 2025, because we time our trades not based on an individual asset, but here's the other beautiful part of global macro. You time your trades, entry and exits, based on volatility and ratios. You don't look at a chart by itself. You don't look at an asset by itself, but in relation to other assets that are correlated to it. If it's risk on, risk off, you can still trade the spreads. And this is exactly what we do here for the dollar bonds. So when we look at the long-term version of this trade, we would want to get into bonds and then start shorting the dollar on a risk off day. But we have to time this trade correctly. So we look at the spread or the ratio between bonds and the dollar. And as you can see here, we have a pretty significant bottom. I don't want to say triple bottom. I don't want to say support, because I would have to start bringing technical aspects into this, and there's nothing technical about a spread. So when we had the decline, this was from 2020 to 2022, and that's essentially inflation. So when we had the inflationary periods of COVID and all the quantitative easing and low interest rates, we essentially saw the dollar outperform bonds, which is why the spread and the ratio goes down. And then we flattened right? So we found the bottom and we stayed in that channel because of uncertainty. We don't know if we're going into hyperinflation. We don't know if we're going into recession. We don't know if you're going into stagflation. So this spread and that channeling tells you that the market doesn't really know what to price in for the next 6 to 9 months. And that is essentially where we start to get into the trade, but only at the right level. So once we saw, this is essentially in late November, early December of 2024, we decided to get in because we started hitting the same bottoms across the same level that we saw during the inflationary bottoms of 2022, 2024. So essentially, once we saw the bottom coming in, that has been tested and retested along these years, the narrative cannot keep going as far as inflation, because that decline in the spread, that decline in the ratio meant inflation. So if we're bottoming and we're starting to flatten and then we get an entry signal, that means the market is not pricing in inflation anymore. It's pricing in something else, which in this case might be stagflation, might be recession. And if you read our previous newsletters about this, then you understand why we're looking into recession and not stagflation. So I want to get technical again, but we can start looking at other timing tools, which are through correlation regimes. So you can see how there's usually a cycle in correlations between assets, and this is only the dollar bonds, but you could do this through any other asset like gold, oil, dollar oil, bonds oil, S&P, whatever you want to do. But if you can spot the correlation regimes and why they're going up, why they're going down, they're going to understand how to time your trades correctly, especially when you're looking at spreads on top of that. So right now, you can see that the spread between the dollar and bonds has gotten so wide that we now need to converge the two, which is why you see correlations start to bottom at a negative. So if they become positive, it means they start to move in the right direction or in the same direction. So in this case, we either get a bond rally, which we have been getting, or we get a dollar sell-off, which we also have been getting. So now you see the uptrend in correlations here, and essentially we want to get it into the 40 to 50% mark, and that's when we know that we can start maybe to unwind this trade, maybe start buying back some of the dollar shorts, maybe selling some of the bond longs, and then see what happens from there. So that's pretty much everything that covers the global macro breakdown. So to recap, without going into everything else that's over here, that's just talking about our coaching program, where we cover everything of this sort. We cover order flow, we cover all the statistical tools, the macro data, the Excel models, the Python models that you need in order to break down ideas in the same way that we just did right now. So for now, I just want to leave you with this newsletter, and the key takeaways would be each day you have to start with the bias. Are we risk on? Are we risk off? Take this list, take the list of risk on assets, the list of risk off assets, understand their spreads, spread them out every single day, and look at when we get to certain levels that are significant historically, and when the narrative for the economy is starting to change, so such as it is right now. For the dollar bonds, we went from inflation, we bottom on the spread, and now we're looking at either stagflation or recession. So when you keep track of these spreads, you keep track of correlations, you not only have the right idea to trade behind each asset class in global macro, but you also have the right timing. And this is why we started going into this trade in November, and about 6 months later, we're sitting on a pretty good profit, and we're going to hold it until correlations or narratives tell us to get out. You can do the same for yourself, any given asset class, any given stock, long short equity portfolios. This is the way that global macro traders work, and this is the way that the industry is going. So on that note, here's the link below. You can look at this newsletter, keep it for yourself, copy it, keep it in a Notion for your own files, and I'll see you guys in the next one. Happy trading.